everybody. I am Kevin Clark, the CEO, the co-founder of Plan Confidence, also known as Cousin Kevin in certain circles. I am the one responsible for programming the Plan Confidence software to make sure that you get the proper investment advice each and every month. So, hey, December 1st, 9 a.m. Eastern Time, you should have received an email or a push notification if you're using our app to log in and look at the future contributions or money that's going into your 401k plan with your next paycheck. So if for some reason you haven't received an email or a push notification, please check your junk or your spam folder to see maybe if we slipped into there. And if not, please let your advisor know that you're not receiving them so we could double check it, or send us an email at support@planconfidence.com and we'll double check to make sure that it didn't bounce or we have the proper email address and all that good stuff. So those future contributions, again, just log into your portal. Whether you're using the app or whether you're using any browser. And this is the future contributions. There's going to be 3 of them. This is not them. Those are from last month. But there's going to be 3 of them very specific to the investment options that you have within your plan. This month, we're going with foreign large blend, long government bonds, which we used last month as well, and small growth. Last month, we used small value. This month, we're using small growth. And I've got the nerd stuff that we monitor. We were pretty good with 2 out of 3. The U.S. long government actually surprised us, and last month was up almost 5%, which is very strange with the markets going up the way they were as well too. So anyway, double check your future contributions, take a look at those, and make sure that you update your plan accordingly. All right, let's look at the market returns real quickly. This is a market update. So month to date, November was really good. Almost everything was up that we tracked. The S&P, the Dow, and the NASDAQ were all up over 5%. The S&P and the Dow were up almost 6%. The NASDAQ was up about 5.3. Year-to-date numbers, not so good. The S&P's down about 15%. The NASDAQ is down about 28% still year-to-date. The Dow, the largest 30 companies, some of the largest 30 companies in the U.S., is only down about 5.5% year to date. So the markets are starting to turn around. We don't know if this is going to continue. We do know yesterday, Wednesday, Chairman Powell gave a speech and then sat down for an interview and questions and whatnot. And he did mention that starting their December meeting, the Fed, the Federal Open Market Committee, the FOMC, they decide every 6 weeks or so what they want to set the interest rate for banks to borrow money from the government. That's the federal funds rate. That then trickles down into everything else, from credit cards to new mortgages, home lines of credit, things of that nature. So to battle inflation, they need to raise interest rates to kind of tame that. They did mention that starting in December, they may start tapering and not doing maybe 75 basis points, but maybe less aggressively, to see if that we're starting to get what we call a soft landing in the economy. So if they keep going too hard, too fast, eventually the economy is just going to crash. There's going to be a bunch of massive layoffs and jobs and a massive recession and all that. The Fed is trying to avoid that. So if they start tapering, they might say, hey, look, let's see if we could try to land this plane softly versus, just killing it with these high interest rates. But inflation is going up slower, but it's still going up. Santa rally. You're going to hear this term quite often, a Santa Claus rally going into year end. I believe it. I believe in Santa Claus still. Why wouldn't I believe in the Santa rally? The Cyber Monday and the Black Friday spending was outrageous. It was way more than any of the economists were expecting. They were expecting doom and gloom and the consumer to really pull back. I say every year that parents are not going to kill Santa. They're still going to do whatever they have to do in order to put the gifts under the trees. The retailers responded dramatically by slashing costs. They have a lot of built up inventory, with that big bottleneck with all those ships over the summer. That's all sitting in warehouses now, and they try to get rid of all of it. Coming through Christmas, a lot of good sales. Consumers responded. However, and this is a little scary part on my end, is they responded, they spent a lot, but a lot of that went on credit cards. Consumer debt is going up dramatically and consumer savings is going down dramatically. So people are starting to spend money that they don't have, which could come back and bite us sometime in the next year or two. So but I do believe in a Santa rally. I do believe this momentum could continue, although nobody has a crystal ball. So, and I'm pathologically optimistic, but I do believe that no one's going to kill Santa. And we as consumers are still going to put gifts under the tree, regardless what the economists have told us. Okay. As a big nerd, I keep an eye on the charts. This is essentially just a chart of the past and telling us what happened. So this is kind of what we look at when we're starting to look at for the future contributions and whatnot. So this is sorted by the 4-week return. You can see here the S&P 500 was up, almost 2%, 1.63% for the last month. However, look at this. Anything that was outside of the U.S. Was up massively. The foreign indexes way outperformed anything here in the U.S. except for bonds. Bonds did really well last month as well too, and then anything with growth in its name did poorly. So we still, even though things are turning around, we still have a penchant for more of the large value, more of the conservative side of the stocks on that side versus the large growth. So that's those played out. Now, if you look year to date, if we sort this and we get all nerdy about it, um, you're going to see energy, systemic trend, commodities broad basket, and Latin America stock are the only categories of the major categories that we look at on a month to month basis that are positive for the year. And energy is massively positive, up almost 53% year to date. Unfortunately, most 401k plans do not have energy as a holding. So hopefully you're working with your advisor and coordinating the 401k with the diversification that you can, given the options your employer chose, and then sprinkling in what you can't do within the IRAs. Energy massively outperforming. Again, when we look at this, the trend for the full year, value stocks, then bonds, then blend style investing, then growth style investing. Growth, again, being the worst performing global class, if you will, as a lot of risk was taken off the table this year. Um, Okay, this is about as nerdy as I'm going to get here, but I'm going to show you one of the charts that we look at on a day-to-day basis to figure out the tactical models and exactly how much equity we should be investing. And all of our tactical models have been fully invested as of September 13th. When the Dow was down about 1,200 points that day, we fully went back into the markets with all of the tactical side. Now, this is a chart of the S&P 500. So this line here is the rate of return. This blue squiggly line is its 50-day moving average, and this red line is its 200-day moving average. Now, anytime it goes below an average, it's bad. So here you can see this is what we call a death cross, when the 50-day goes below the 200-day and we're still there. Normally when that happens, you see of massive losses, which is exactly what occurred here. Then it bounced, almost got above the 200-day moving average again, found resistance, fell again. Luckily, didn't stay below the 200-day or 50-day very often. Popped up, false positive, came straight back. Now, we broke through the 50-day, and today we literally broke through the 200-day moving average. We're going to see if it's a situation like it was back in April, where we're only there for about a week or so before it plummeted, or are we finding new support? Before that used to be the ceiling. The 200-day was about the ceiling. I'm not confident that it's not that it is the ceiling still. I think that we're still going to get some volatility, even with a Santa rally and all that. I still think we're going to see a lot of day to day volatility. The Down here, the squiggly lines at the bottom of the chart, this is what we call the MACD, or the momentum convergence divergence lines. When the black line is above the red line, it's a good thing. When the red line's above the black line, it's a bad thing. You could see as of today, at the very end of the chart here, we were about to cross again, which would have been bad, but it just took a little turn to the uptick there with Powell's comments today. So what happens is we put this into an Excel spreadsheet, which is this. So you can see at the top here, we have the 50-day moving average, the 200-day, the MACD, the signal, and then we tell you exactly what it is. This is the research we use. We use red, yellow, green light kind of signals, no different than a traffic light. You can see really from all of November here, we have a lot of green on this chart. There's been a lot of good days. There's been a lot of buying signals that are out here. The sell signals, the VIX, anything above a 20 was normally considered a panic until COVID hit. We've pretty much been above 20 ever since that. So the VIX isn't necessarily the best signal anymore because you can see it's literally been above 20. If it gets below 20, we almost got below 20 right before the day after Thanksgiving on Friday. We almost got below 20, but we didn't quite sustain that. Now, with that, we look at this. If 2 out of the 3 signals go negative for 3 days in a row, that's when we start to look to limit equity exposure. When 2 out of 3 of these are in a positive or a hold sign, then we stay fully invested. So this is the process that we use. We look at that chart, we get the 50-day and the MACD signal, and then we look at the CNBC website every day for the volatility index or the fear index, and we decide how much of the money we should have fully invested within our tactical models. So as of right now, going back to the chart again, I'm cautiously optimistic. But I'm not sure how much longer we could stay above this red line, just because we found resistance over that red line really since everything started going down in the beginning of the year in February. So we'll see. I'm cautiously optimistic that this could be the sign of a good thing. I'm not sure if we're there yet, especially since the MACD coming so close to crossing over, but we could see a little run within the next 3 to 4 weeks with the Santa rally, or we could just continuously see volatility like we've seen all year long. So that's what we look at in terms of the charts and what we're doing. We're not just throwing darts at at a wall to figure out where we want to be, or flip a coin to decide if we still want to be invested in the market or not. There is a lot of thought process put behind it. If you do have any questions, please reach out to your advisor. Let them know. As always, as the CEO and the co-founder of Plant Confidence Corporation, I do thank you for choosing Plant Confidence for your personalized ongoing investment advice. And with that, I am going to wish you very happy holidays, and I will touch base with you in the new year. Peace.